Key point: avoiding investment mistakes. Welcome back to our channel, dear viewer. Today, we're diving into a particularly important topic that is often overlooked: the top 5 investment mistakes young people make and how to avoid them. We all make mistakes, but when it comes to investing, those missteps can cost us dearly. So how can we avoid falling into these financial traps? To help you navigate this complex landscape, we'll be exploring these mistakes through the eyes of some of the most successful investors in history, like Charlie Munger, Ray Dalio, and Benjamin Graham. We'll dissect their strategies, their wisdom, and their advice to help you sidestep these common pitfalls. Whether you're a seasoned investor or just starting out, it's never too late or too early to learn from the best. So buckle up and get ready to embark on an exciting journey to financial wisdom. Let's dive right in. Key point: the importance of starting early. Ever questioned what sets a thriving investor apart from one who is always striving? The key often lies in the blunders they make. In this discussion, we're going to dig into the most common investment stumbles made by young folks and how to bypass them. Ready to plunge into our first pitfall? It's called not starting early enough. To fully understand why, let's reflect on the tale of Charlie Munger, Warren Buffett's celebrated collaborator. This financial whiz was already delving into the world of stocks at the young age of 11, passionately championing the principle of compound interest. With his famous dictum, "The first rule of compounding, never interrupt it unnecessarily." The moral here is straightforward: embark on your investment voyage as soon as possible. Let's examine a case of two pals, Alice and Bob, to illustrate this. Alice initiates her yearly investment of $2,000 at 25, while Bob begins his quest 10 years later. Assuming an annual return of 7%, by the time they both reach 65, Alice will have accumulated almost $400,000, while Bob will have just over $200,000. So, the secret to Alice's amassed wealth? A mere 10-year head. Key point: investing in what you understand. The second blunder people often make is investing in something you don't understand. Benjamin Graham, widely recognized as the progenitor of value investing, underscored the significance of comprehensive examination in investment decisions. He expressed the sentiment that investment is most perspicacious when it is most businesslike, implying that it's vital to grasp the business fundamentals prior to investing your hard-earned money in it. Picture this: you catch wind of a surging tech stock from your acquaintances. Without having a full grasp of the company's operations or its financial soundness, you take the leap and purchase the stock. To your dismay, its value takes a nosedive following an unfavorable earnings announcement. This situation accentuates the peril one exposes themselves to when investing without a thorough understanding. Key point: the risk of not diversifying. The third common investment mistake is putting all your eggs in one basket. This belief is strongly held by Ray Dalio, the founder of Bridgewater Associates, as he emphasizes the crucial role of diversification in investing. You can see this principle in action in the portfolio of Asia's wealthiest person, Li Ka-shing, whose investments are spread across various sectors like real estate, retail, and telecommunications. Now envision pouring all your resources into the estate market, falsely assured of its safety. A sudden housing market crash could result in major losses, thus highlighting the peril of a non-diversified portfolio. Key point: summary and conclusion. In conclusion, steer clear of these habitual investment blunders: not commencing early, putting resources into businesses you have no knowledge about, and not diversifying your portfolio, not beginning early, investing in businesses you know nothing about, neglecting to diversify portfolio. So get started early, gain understanding prior to investing, and enrich your portfolio with diversity. These are the building blocks of a prosperous investment journey. Key point: the pitfall of chasing past performance. In our journey of uncovering common investment mistakes, here's another one that even seasoned investors often fall for: chasing past performance. As the great Charles Munger once warned, those who will not face improvements because they are changes will face changes that are not improvements. In a nutshell, don't get stuck in the past, focus on the potential for future growth. Renowned investor and author Philip Fisher echoes this sentiment. He advises investing in companies with strong potential for future growth, regardless of their past performance. As Fisher wisely noted, the stock market is filled with individuals who know the price of everything, the value of nothing. Now let's illustrate this with a real-life scenario. Imagine your friend Billy tells you about an investment fund that had an impressive 20% return last year. Excited by the fund's past performance, you decide to invest a hefty sum. Unfortunately, the fund's strategy doesn't work as well this year, and it only returns 2%. This example clearly demonstrates the risk of making investment decisions solely based on past performance. So remember, don't get lured by the past glories of an investment. Instead, do your homework, understand the potential for future growth, and make an informed decision. Because, as we've seen, chasing past performance can lead to disappointment. Key point: the danger of not having a long-term plan. In our exploration of common investment mistakes, the next one is a trap many fall into: not having a long-term plan. As the legendary investor Benjamin Graham once asserted, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that while market sentiment can drive price fluctuations in the short term, in the long run, the market accurately reflects a company's intrinsic value. Graham believed in a disciplined and patient approach to investing, emphasizing buying stocks well below their intrinsic value and holding them until their price accurately reflects their true value. Another advocate of long-term investing was John Bogle, the founder of Vanguard Group and the creator of the first index mutual fund. Bogle was a firm believer in buy and hold investing and emphasized the importance of sticking to your investment plan despite market fluctuations. He famously said, "Time is your friend, impulse is your enemy." Let's bring this concept to life with an example. Imagine you start investing in stocks, hoping to make a quick profit. You constantly buy and sell stocks based on daily price. Over time, you realize that the transaction fees are eating up most of your profits, and the stress is taking a toll on you. This is a typical result of not having a long-term investment strategy. So, in your investment journey, remember the importance of having a long-term plan. This will not only save you from unnecessary stress, but also help you achieve sustainable growth in your investment portfolio. Key point: embracing the learning curve. As we continue our journey through the most common investment mistakes, it's essential to remember that making mistakes is part of the learning process. No investor, not even the greats like Warren Buffett or Benjamin Graham, started off without making a few missteps. But what sets successful investors apart is their ability to learn from their mistakes and adapt their strategies accordingly. This is what we call the investment learning curve. Every mistake you make gives you a new perspective, a new lesson, and a stepping stone to becoming a better investor. It's not about never making mistakes, but about not repeating the same mistakes. As the famous investor Peter Lynch said, the key to making money in stocks is not to get scared out of them. Your investment journey is bound to have ups and downs, and that's okay. Embrace the learning curve, stay patient, and keep refining your investment strategy. Remember, the most successful investors are not those who made no mistakes, but those who learned from their mistakes and kept going. So, keep investing, keep learning, and most importantly, keep moving forward. Key point: the power of patience in investing. Patience is a virtue, and when it comes to investing, it's than just a virtue, it's a necessity. It's easy to get caught up in the excitement of quick gains. But remember, the stock market isn't a get-rich-quick scheme. It's a vehicle for long-term wealth creation. Investing is like planting a tree. You don't plant a seed today and expect a fully grown tree tomorrow. It takes time for the seed to sprout, grow, eventually bear fruit. The same principle applies to investing. Your investments need time to grow and compound. So resist the urge to constantly check your portfolio or panic when the market takes a dip. Remember Warren Buffett's words: "The stock market is a device for transferring money from the impatient to the patient." So, cultivate patience, sit back, and let your investments do work. In the long run, a patient investor is a successful investor. As we wrap up this section, remember that investing isn't a sprint, it's a marathon. So pace yourself, stay patient, and keep your eye on the prize.